Hello, everybody, and welcome to another episode of Ryan's Rules of Investing. My name is Ryan, and today I want to talk about how to properly take a loss. Now, sometimes, not a lot, very, very seldom with me do I ever have to take a loss. Sometimes it's what we call a strategic loss or a smart loss, right? So what I want to talk about is how to take a loss. You just don't sell a stock when it's down for no reason. That would be very stupid. So let's talk about it. So let's say I have a stock and I'm down like 80% or whatever, and there's a big loss to be taken on that, right? I hate quitting. I hate selling. But again, you've lost, a lot of people think, well, I've already lost 80% of the stock. Why not just hold the 20 and hope it comes back one day? That's true. You could do that. Or you can take the remaining 20 and invest it somewhere else. And you can also take a loss to help you on your returns. So what we do is basically, we can take a loss against some of the gains we may have had as well. Because sometimes, one of my other previous videos, I talk about a trailing stop. Sometimes the stock sells before I really want it to sell, but it's going down and I want to lose my profit. So it sells. And then I end up making $80,000 or $100,000. And I'm like, I want to make money, but I don't want to pay tax. And it's, for all intents and purposes, not in a tax deferred account or a retirement account where you can allow losses or allow gains. With that being said, what I'll do is I'll normally wait until the end of the year, see what stocks I really don't like, I want to get rid of. Because here's the deal, guys. Here's a little golden secret. You sell the stock, you take the loss. To avoid what's called a wash sale, you have to wait 30 days before buying another stock in that same kind of realm again, right? Because they don't want you to, game the system basically, right? But what we do is you just wait 30 days. So you sell the stock. Let's say it's down to like $3, right? It was at $30, now it's down to $3. You sell it, you take a huge loss, take it against your other gains that you'd be paying tax on. So you don't have to pay tax on that money, right? Then 30 days later, 31 days later, you can always buy the stock back. So just write down or keep a log of which stock you sold or look back in your account history. And then you can always rebuy the stock back. And chances are it'll probably be lower than what you originally sold it at as well. If it's constantly going down, it's going to keep going down. So that's the way to properly take a loss. You just don't want to haphazardly take a loss and say, investing sucks. No, there's a smart way to do it. There's a smart way to do everything. And if you read my book, Ryan's Rules of Investing, I'll teach you all those ways. It's $27. It is a couple hour read, maybe 2 hours it takes to read. All good information, a lot of pictures. I like pictures. Go ahead and buy it. Don't forget to click the like and subscribe button. And if you have any comments or questions, leave them below and I'll answer them. And let's keep investing, guys. Have a great day.